Canadian economy has the strongest growth among G7 countries in the first quarter of 2023. The Canadian economy knocked it out of the park with the strongest growth among G7 countries in the first quarter of 2023. A 3.1% advance in real GDP got the attention of the Bank of Canada, particularly when followed by hot inflation and housing markets in April. That was more than enough evidence for the central bank to press play on rate hikes and take the overnight rate to 4.75% in June. With our forecast for economic growth being upgraded, we expect the BOC will hike rates again in July to 5% as it enters this trial and error stage of fine-tuning the policy rate. Canadian consumers were quick out of the gates this year, on healthy durable goods spending. This should lose steam quickly through the remainder of this year. For instance, auto sales provided a significant lift to consumer spending from the tail end of last year through January 2023, but momentum has since petered out. Even so, the overall consumer spending profile received an upgrade within the forecast, with the timing for any contraction pushed back to 2024. As in the US, the slowdown in the labor market is similarly delayed. The job market showed signs of cooling in May, as the unemployment rate rose 0.2 to 5.2%. But, given the natural volatility in Canadian labor force data and the concentration of job weakness within a very narrow youth age cohort of 15 to 24-year-olds, we don't perceive this to be the right signal that a broader trend has taken hold. Elevated commodity prices, the energy transition and a robust pipeline of infrastructure projects are leading to a similar outcome on investment as observed south of the border. Non-residential investment has displayed surprising resilience in the face of higher interest rates. However, that near-term strength is offset by a downgrade to 2024, as major projects ramp down and the lingering effects of higher interest rates bite into capital expenditure intentions. Residential investment has been in steep decline for 4 consecutive quarters in response to higher borrowing costs. Real estate activity in Canada is picking up more than in the US, and population growth and years of undersupply are expected to drive greater investment north of the border over the next 2 years. A hotter start to the year has turned up in greater momentum in core inflation, which we expect to remain elevated through the remainder of this year. Although headline inflation is still set to decelerate to 3% in the near term, this will largely reflect last year's high energy costs rolling off. The BOC will be focused on the dynamics within core metrics, which proved unexpectedly sticky in April. With another hike still being contemplated, it would be unusual for a rate cut to materialize in early 2024 absent a harder landing in the economy. We have pushed back the timing for interest rate cuts until the second quarter of next year, but even this could prove optimistic if core inflation metrics fail to offer convincing evidence of decelerating back to the BOC's 2% target. The central bank will be gauging the real interest rate and the degree of tightening it's creating on households and businesses. Typically, a real interest rate in the 1 to 2% range has been consistent with hard economic landings. With the BOC now keeping pace with the Fed, we see some near-term upside for the Canadian dollar, CAD, versus the US dollar, USD. But once the BOC gets the policy rate to 5%, interest rate differentials will play less of a factor going forward. We also don't think the swings in energy prices will influence CAD as much as in the past. The US has become a net energy exporter, muting the relative advantage Canada had in the past when oil prices rose. The ups and downs of investors' nerves and flight to safety flows into US dollars have been the biggest driver of the CAD versus the USD over 2023, and we think this will be the main driver over the rest of the year and into next. The global economy has evolved largely in line with our expectations since March. There is a modest upward revision to global growth this year, offset by a slight downgrade in 2024. The euro area is the exception to this pattern, and the recent rise in European natural gas prices is a reminder of the persistent risk of shortages the region could face next winter. Meanwhile, China's economy burst out of a zero-COVID world more vigorously than we had expected in the first quarter, but the near-term signals suggest it is slowing rapidly. Growth is expected to cool through the remainder of the year, and we have downgraded China's GDP outlook in 2024. How Chinese policymakers respond to slowing growth presents an upside risk to the forecast and inflation. Small rate cuts by the PBOC are not enough to move the needle on their own, but if they presage broader stimulus measures, it could lead to an upgrade to the outlook. Once again, the US economy resisted recession calls with a stronger-than-expected start to the year. Although we were not in this camp, economic growth in 2023 still needed to be modestly upgraded by 0.2% PTS to 1.5%, reflecting an expectation that the second half of the year will reveal a softening profile in consumer spending. Thankfully, Congress came to an agreement to suspend the debt ceiling, removing a key source of risk to financial markets. The lower spending trajectory in the Fiscal Responsibly Act is estimated to create a mild drag of 0.2 percentage points, PTS, and 0.1% PTS in 2024 and 2025, respectively. This has served to reinforce our conviction that 2024 could be a challenging year with economic growth of only 0.8%. Once again, the U.S. consumer has carried the growth torch, with inflation-adjusted spending rocketing ahead at a 3.8% annualized clip in the first quarter, the fastest pace in nearly 2 years. High-frequency credit card transaction data through May suggest a cooling is in store for the second quarter within a 1.5 to 2.0% range. However, that's still a pretty good outcome coming off supersized strength. We would be remiss in not reminding readers that we've held a long-standing view of a desensitized household during this interest rate cycle due to stronger starting points in income, savings, and job demand. Many of these positive starting points remain in place today but are slowly deflating from elevated levels. If there is one area that could again surprise on the upside, it's the resiliency of the consumer. However, the forecast embeds a wind down of spending momentum as the year rolls forward, as headwinds from higher interest rates continue to build and some households face a new challenge related to the end of a 3-year student debt payment moratorium. Business investment is already showing the markings of higher borrowing costs and tighter credit conditions. The performance has been uneven, however. Most of the burden has been reflected in equipment outlays, while investment in non-residential structures has delivered surprising strength. We anticipate this divergence will persist. The latter appears to be already reaping the benefits from onshoring, and various measures passed by Washington to encourage domestic high-tech production have started to goose the construction of manufacturing facilities. In contrast, residential investment will remain a drag on economic growth this year, before starting to recover in 2024. So far though, the labor market continues to plow ahead. As of May, the 3-month moving average on job growth sits at 283K per month, more than 3 times what is required to meet trend growth in the labor force. While the breadth of hiring has narrowed from last year's high, it is still hovering at a level consistent with the 2018 to 2019 pre-pandemic period. Meanwhile, job openings ticked higher in April, and data from Indeed have shown a similar pattern of job openings failing to dip and instead moving sideways through May. Taken alongside the still low level of jobless claims suggests the labor market has some room to run. Our forecast assumes only a mild 1.2% PTS increase in the unemployment rate to 4.7%, with that movement concentrated in 2024. Not surprisingly, a resilient labor market and consumer means resilient inflation. As a result, the outlook for inflation in 2024 was revised higher, and core PCE inflation is not expected to reach the Fed's 2% target until the first half of 2025. This is one area that has led to a more material shift in our forecast call. We doubt the Fed will be in a position to cut rates until the second quarter of next year, at the earliest. That's a 1-quarter pushback from prior expectations. In addition, we suspect the Fed will raise rates another 25 basis points to 5.5% for this longer period. At this phase in the cycle, they may pursue a stop-and-go approach, as already seen by central banks in Canada and Australia. Should inflation and the job market continue to exceed expectations, we cannot rule out even more adjustments by the Federal